Friday, October 7th, 2022, Maneco 64, home of alternative economics and contrarian views. So today, we're going to look at the Federal Reserve and why I think the Fed's credibility is almost ready to blow apart. I think they're losing complete credibility with the markets, with investors. And you might think, wow, they're acting really tough. But I'm going to explain to you why I think otherwise, and we'll look at the jobs number as well that came out earlier today. Before I start, though, I'd like to give you an update on my wife's and I holidays here in Madeira. Well, Madeira, of course, is the way it's pronounced in English. In Portuguese, it's Madeira, which basically means wood. And we'll go through the history a little bit, and also I want to talk about our experience yesterday walking into the capital, Funchal. We walked from the hotel there. It's not that far away. But Madeira, or Madeira, was discovered by a couple of Portuguese explorers, I guess, or sailors, back in 1419, and the Portuguese started settling it in the 1420s. So it's been here for 600 years, and I think in the beginning, in the first 100 or maybe 150 or 200 years, they grew a lot of sugar cane here, and they were a great exporter of sugar to Europe. But then Brazil and the Caribbean were developed, and the sugar plantations there were much bigger. So Madeira had to transition, adapt, and they started growing stuff like grapes for wine, and that's why Madeira wine is so famous. And the name Madeira, of course, is because when they discovered the island, it had a lot of trees, and it still does. So they call it the wood island. But that's about it, about the history. I mean, you can look it up. And it's been under Portuguese control since then. And it's an autonomous region of Portugal. It's part of Portugal, but it has its own regional government. And yeah, as I said yesterday, we walked into the city or town. It's about 20-25 minutes, not far. You can get a cab as well. There's a lot of taxi cabs around, not Uber, just the yellow cabs here. And I actually wanted to have a look around to see if they had any coin shops or places where you can buy and sell gold and silver, and they do. They have loads of that. I even went into the local coin and stamp shop, as you can see here, and I bought a couple of silver coins. One was from 1879. I think it was a 50 reais, and it was minted in Portugal but sent to be to circulate in Madeira. And the other one is an 1899 1,000 reais from Portugal, as you can see. And yeah, the guy was very good. The coin specialist. He told me everything about the coins, and yes, he had all kinds of silver as well. I didn't really ask him whether he had gold coins. He probably did. But I also found there are places where you can go to sell gold if you want cash. It's like a bureau de change, so to speak, for gold. The prices not that great, but you can, if you bring gold to Madeira, a few coins, you can exchange it for euros, for the local currency. And I had a word with one of the guys in one of these shops, and he was telling me that Madeira is really safe. And I walked right in. There's no security or anything, and it's very clean as well. I would say it's got its own municipal theater. It's a really, really nice place. And he told me as well that with the Portuguese law that gives someone they call it a golden passport, if you buy a property of at least 500,000 euros, So it's not just in Madeira, but the whole of Portugal, I think. And they give you a residency and a passport. But I think the European Union is probably not too happy about that. I don't know how long that's going to last. And the top rate of tax also in Portugal is 28%. And he told me that there are a lot of French, wealthy French who earn over €1 million a year. They buy a place here and they get residency, and they keep living in France, but instead of paying 50% tax on every euro above €1 million that they earn, they only pay 28%. So there is tax arbitrage, not just in Madeira, but also in Portugal. But it's one of the reasons why property prices here are quite high, especially near the center of the city, the capital, Funchal. So yeah, I really enjoyed it yesterday, walking around. And on Sunday, we're going to take a shuttle service that is going to take us around the island. It's going to be 2-3 hours to see all the interesting places in Madeira, or Madeira. So that's a little bit of history and a little bit of the flavor of the place. The people are actually very nice, and the food is good. Service is good. Yeah, it's a gem, I would say, Madeira or Madeira. So back to markets and economics now. And yes, I watched this morning quite a bit of Bloomberg TV. As you know, I usually don't watch that. And one thing that I'm like, I guess not surprised, but still a bit shocking, that they're looking at things still through this old paradigm that we've had for the last 20 years or so in financial markets. It's like they don't even like, they're not even thinking differently about inflation, and the fact that I think inflation is going to be a problem going forward for many years, if not for the next 10 years. And they seem to think, from watching all the commentators today, especially with pre-non-farm payroll, they brought in a lot of economists. They all think that magically inflation is going to come down to 2 or 3% in the next few years. And I think they're going to be proven wrong. And as for the Federal Reserve, yes, why do I think they're losing credibility, and they will lose credibility? Well, because they inflated for too long, and no one talked about this on Bloomberg TV, all the money printing. They all seem to be blaming the wage pressures for inflation, which is completely like nonsensical, because in a healthy economy, if we had a healthy economy, the more employment you have, the better it is, because people are producing more things. The problem with our Western model is that our economies are based on consumption and credit, and the Fed allowed that to run too hot. And yes, there are probably a lot of jobs there that are not really productive jobs, like in services. And maybe that's what the Fed wants to cut out, all the credit induced spending. But I think they're too late. They're too late. They should have started raising rates. Well, they tried back in 2017, 2016 to 2018, and there was a huge accident. There hasn't been an accident yet in the U.S. There was an accident in the U.K. recently, and I think it's going to spill over. But the Fed seems to be saying now, we don't care about accidents. We're just going to raise rates, and whatever happens, we don't care. We just want to lower inflation or CPI. But no mention, of course, of the fact that they inflated the money supply massively in 2020, 2021. The fact that they kept rates so low and did so much QE when inflation was going up, and the economy was supposedly doing well. So the non-farm number today, I guess, came in line, just a little higher than expected. It looks like the markets, especially the stock markets, didn't like the number because it means the Fed is going to stay quite hawkish. They're going to raise in November and probably in the meeting after that by 75 basis points each time, or maybe they'll raise by 50. Who knows? And the fact that the unemployment rate dropped to 3.5, I think the markets didn't like that, nor the average earnings rising at 5% a year, which is still negative. People are still getting hit hard because the cost of living is going up. I would say more like 10%, not the 8.3 that we're told. And yeah, if we look at shadow stats, it's more like 15 or even 17%. The bond markets, yes, yields have risen a little bit today. They're up about 4 basis points across the board. We've got the 10-year at 385, high was 391, and the 2-year got up to 435. It's now at 430. And I've noticed that the Bank of England, they haven't really been using or doing QE like they said they would last week. They only announced that, I guess, to calm the markets. And unless they start doing QE, real QE now, you know, they promised 65 billion up until October 14th. I can see the gilt market getting in trouble again because we're seeing like the 30-year now almost back up to 4.5%. It's up another 10 basis points today. The 2-year is at 410. The 5-year is at 445, up 8. So I think, yes, the UK economy is set to decelerate very sharply and very quickly, in my opinion. I saw that business closures were the highest since 2009. So I think we're just about to go into a recession. And that's the other thing on Bloomberg. All the economists are saying we might have a recession next year. Well, we already have one this year. We had 2 consecutive quarters of negative GDP growth in Q1 and Q2. I don't really understand how they can talk to the world and say that there is no recession. That's another gripe I have about watching the mainstream, but it's sometimes good to do so. And yes, what about our favorite metals, gold and silver? Yes, they've been hit a bit today. Silver has come off. It is testing the 20 level, but I would say it's holding relatively well, and all considering. So it is just before 5 p.m. Time here in Madeira, which is the same time as London. So it's noon in New York or Eastern time. So we've got spot gold at 1702.30. It's down about $10. High's been 1715, and actually the low was 1690, just after the non-farm number. So we're down about 0.5% in gold. So not too bad, really, I would say, and we're holding that 1700 level. It's still early days, I guess. Spot silver is down about 45 cents, or down 2%. And that's the thing with silver. It outperforms when the market's going up, but when it corrects, it underperforms. But I still expect silver to outperform gold going forward. It has been outperforming gold in the last month or so, I would say. So right now we're at 2020. The high was 2084 and the low was 2008. The Dow futures is down almost 500 points, or 1.6%, at 29,444. The NASDAQ 100 future is down 3%, 350 points. And the S&P 500 is down 2%, just over 2%, at 3664. So the stock market doesn't like this. The bond markets don't like it either. And I think you hear very little about commodities on Bloomberg or CNBC. there's no one there talking about the fact that there will be a massive shift in relative terms, and that's how I see it in the coming decade, towards commodity and out of paper. They seem to think that the Fed is just going to fix things and we're going to go back to normal to rates around 2 to 2.5%. I think they're dreaming, to be honest. So let's continue with the currencies. Sterling is down about 0.5%, 111.12. The euro is unchanged at 97.84. The dollar is up slightly versus the yen at 145.20. Dollar is up slightly versus the Swiss franc at 99.13. And the dollar is up 0.5% versus the yuan at 711.80. Let's check the Russian ruble. Yeah, the dollar's up 0.5% at 61.80, just below 62. Dollar's creeping up a little bit against the ruble, I've noticed recently. And we'll go straight to the commodities. The commodities are doing well, especially crude oil. WTI is up over 4% at 91.80. Brent crude is up 3.7% at 97.50. Yeah, stagflation. We are in a stagflation because we got negative growth in GDP, and we got a high inflation. So that's the other thing as well. You don't hear these people on Bloomberg ever mention that word, stagflation, or at least I didn't hear it this morning. High-grade copper is down 1.4% at 338.85. U.S. nat gas is down 1.3%. And let's just check the Dutch nat gas futures, see where that is. Well, that's actually come off a bit. It's down 11% at 155. Yes, it might seem very low, but it actually was trading around 10 or 15 prior to 2020. So it's still highly elevated natural gas prices. And I guess now oil going up doesn't help either. So we're going to be here until Tuesday morning. We're flying out around noon on Tuesday. And should be back to normal scheduling of the videos by Wednesday. I will do 1 or 2 more videos while I'm here. And yeah, so if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And with that, I wish you all a great weekend. Take care. Bye.